Okay, good evening, everybody. Let me first put out the course materials and as well as the syllabus. Let's look at the syllabus so far, and so in the last class we have covered the assets volatility models, Arch, and the assets volatility models, Garch. And so this week I'm gonna talk about the application of volatility modeling. All right. So my tentative schedule is here, right? Since we have been go through a little bit faster than my expected, right? And I mean next week, today I probably can finish all the materials for this semesters, particularly on the application of the volatility modelings. So that means next week we probably have nothing to do. All right, nothing to do. So let's say if we can finish all the materials tonight, we will not meet next week. So next week we're for your own self to review your own selves. All right. So this is the basic schedule. So if we can finish tonight, we will not meet next week. So what we're gonna do in the next 2 weeks, you can say April 28th, May 5th. Let me look at this calendars. So that means next 2 weeks, I will give you the last assignment. The last assignment. All right. The last assignments will be kind of the final exam, and the format will be quite similar to the midterm, the previous ones. Okay. And so again, so the problems on the final assignment will be quite similar to the examples I'm going to discuss in the class. All right. And there's some little bit coding problems, but will be very, very similar to the course materials that I'm going to talk about today. All right. And so in this case, I will give you 2 weeks to finish. That means next Monday at the early morning of next Monday, you will see the last assignments available. And it will be due on May 5th. Due May 5th. So I expect that. Let me see the calendars. Yeah, I think this less than 2 weeks, but almost there, right? It's more than 10 days. So the due date will be May 5th to submit. All right. So, and the problems will be focused on the volatility modelings, and that's it. All right. So please let me know if you have any questions.
I have a question.
Yeah.
So we have that one last assignment that'll be due May 5th, and then the actual exam on May 5th?
Yes, I mean we will have no. This is purposely my attempt to have a final exam on that day. But like I said, because I think the course materials will be will be better for you to give you 2 weeks to finish some kind of exercise to submit. So it's a better way. So we will have no, like say, sitting there exam. So we will similar the last assignments, give you 2 weeks to submit until that's it.
Oh, okay.
Yeah, so that means that the whole semester you will have 3 assignments, right? And I will grade them in a plus attendance, right? So
Okay.
that's the okay. I hope my idea has been clear enough. And so let's go to today's work. And today's, of course, is relatively important because I have in the past days I have write and all of the codes for today's class. That means I have finished some coding for the gauge and arch models. We discussed the previous days, but we didn't implement that, right? I finished the coding and also upload some the data sets we use, as well as the mini case studies we're going to learn tonight. All right. So in this sense, if you look at your course materials, on the last one, okay, so case examples for modeling volatilities. All right, case volatility. So you will see there is several files on your sites. Okay, let me say. That'll be better maybe. Okay, so here. All right, so this is case examples for modeling volatility. So there's several files, and I want you to take several minutes now to download them on your files for this class or anywhere you want, right? Because in the next few time, I'm gonna open the RStudio and implement the code and demonstrate that the results comes out. And in the meanwhile, when I review the code, I will also review kind of some knowledge about the volatility modelings in the recent 2 weeks were discussed. All right, so I'll give you a few minutes, download them, and let me talk about what's the meaning of that. So lab4gauge.r, the first file, this file is basically all the codes actually relevant to here. The volatility modeling, the gauge and arch, this here. All right. So lab4gauge basically give some examples, okay, the data, how to modeling the volatilities using the gauge. And the next few data sets is for the mini case studies. All right. And we will see what's the meaning of them, right? The data sets. This is stage 5, chapter 5 data.zip. This is a compressed data. And this data will have several data files, including all the company's data and the stock returns we're going to use for today's exercise. All right. And Lab 5 gauge application. This code is for our today's lectures. All right, the case we're going to discuss. And the gauge cases, this is the textbook chapters, the materials corresponding to what we're going to talk about tonight. I also upload here. So this you can kind of like the course materials. All right, though the other is the data sets and the code, right? So you want a download on your computers, right? Make sure you remember the passes because we're gonna run them. And so in our next 2 weeks, we'll have the last assignments, right? This assignments, I will give you some some questions, all right? And the question will be quite similar to the spirit of the exercise we do, all right? So you want to make sure you understand each line of code, right? And the results as well, and as understanding, the gauge and arch volatilities, all right? So before that, let me mention a little bit, all right, on what we have learned so far. I think the volatility itself in statistics is easy to define, but in a time series, it is essentially unobservable. All right, for example, if I ask you, what is today's stock market volatilities? It is actually very hard to define. All right, it's unobservable. So we want to design a model to compute the volatility, for example, today or yesterday. And when we talk about the volatility, we basically mean that conditional volatilities. That means the volatility today is actually depends on past histories. For example, past 3 days or past 2 days. All right, so that's essentially a conditional volatility, not the pure volatility, but conditional concepts. All right, so that's why we need the arch and the gauge model to do that. So let me, how do we start with? And let me firstly, in the meantime, please download those things on your computer files. And let me go slowly, open my RStudio and open the files. Then you will know how to use them, all right? Okay, so let me first to the OpenMR, I'll start my RStudio windows here. All right, and I have already download all the files on my course materials on my computer. Okay, so again, so the first line is trying to define where my course materials located, right? The upper level, the path name. All right, and here you probably need to install a package so-called fgarch, and this is essentially a file to implement the garch models. Right, that package will be easily, conveniently estimate the parameters of the garch models. Okay. So you probably need to install them and the libraries, and after that is you want to call them. Okay, so now let's the random. All right, so right, so there's fgarch, and if when you install those packages, then you will find that there are several things. For example, the warning message, the package fgarch, the time series, fbasics was built. All right, so those are things that means those packages you will be installed also simultaneously. All right, so you don't need to care about them. And then you want to run the data. All right, so the data file we use is intcsp7309.txt files. This file is on our last class. Let's go to my Blackboard. It is here, right? I go to my Blackboard here on the left string. There is intcsp7309.txt. So we will use these files. Okay, these files. Right, so all that means you also need to download all the materials. That means lecture 7 as well as lab 3s, right? Lab 3s, those data, all of them on your data files. The files for last class we use, for example, the rscript_tb.r. This file is for, you can make some notes if you really have no idea what's going to talk about. This file is for testing the arch effects. Okay, the testing the arch effects, ARCH, testing the arch effects. All right. That means if there is indeed conditional volatilities, that means if today's volatility is a function of past days, all right? So we want to test if the coefficient is significant or not. So this is testing the arch effects hypothesis. The arch test.r is for arch test functions. This one is not built into the R packages storage, but instead is developed by the author or other co-authors. So in this case, also you need to download on the same files, because when you run them, you need to call these functions. All right. So again, so you want to intcsp, you want to download this file, and let me go to here. Let's see what is the data it is. All right, so this is the DA here. It's very simple. It's just simply the time series data, the Intel stock returns against S&P 500. All right, the market average. All right, so those data. And let me see how large is it? It's still okay. It's only 444 days. It's not much. All right. Okay, so then you want to take a log returns. You want to take the log returns. And then you want to say take the gauge fit. This is probably the first and foremost we're going to do here. The gauge fit simply means that you want to use the gauge models. But here I want you to understand what's the really meaning of that. And let me open the course materials and then review the model simultaneously. So this is the traditional gauge models, the gauge model format. I'm not saying that my code exactly corresponding to this one. I'm not sure this one is also for Intel data sets. I'm not sure, but it's similar because they might use different data sets, but the function always like this way. Gauge and arch, they're actually very similar. It's similar to, for example, the AR and ARMA, because the gauge model is simply a extension of the arch effects. That means the gauge will include not only the past volatility information, but also include the past shocks informations. All right, so this is the arch one, okay? And the functions, the model usually will have two parts. The first one is that the return will be some constant plus a shock. This one is simply easy to understand. That means, for example, you have a 400 days stock data, right? 400 days. So that is simply means this items, the constant simply means the average. All right, you take the average of all the data samples returns, you put it here. All right, and what is this? This one is a shock, is essentially the deviation, right? Each day's actual returns against the mean average. So that's easy, right? And we know that such a deviation is actually a function of a volatility, which is couldn't be observable, and times some randomness. All right, volatility by itself is a concept which is absolute values, but it could be go down or up, right? Which is uncontrollables. So this is a random variables, and we assume it follows a normal distribution. Sometimes it may or may not, right? And then for the volatility part, the sigma square will be equals to constant plus coefficients, right? Sigma t minus 1. So this is the arch. That means the past volatilities the volatilities depends on the past volatilities. So gauge models simply extend by also increasing the past shocks. That means AT minus 1, right? If you review that. So this is actually usually the function will be looks like this, right? So our task want to estimate the constant coefficients here, constant and the coefficients, right? So this is our task. And so this is so-called the gauge effects. So formula will be the gauge 30. That means gauge 30 simply means arch, right? So gauge and arch differences will be in the second item. So the first, I mean, there's a 3 legs items, like 1, like 2, and like 3 periods. All right, the arch effects. And 1 plus that will be simply means that we assume the mean equation is there's a constant on the mean equations. All right, and the data we use is INTC, the Intel stock returns. We rename it here, but the same name actually. All right, we just simply take a log, and so that's it. All right, and you can see what's going on there. So when you run these lines, it just simply let the computer to run the gauge process, but there will be no output. There's no output. All right. And you will receive, there's an arrow here. And oh, sorry, this is arrow. Yeah, INTC not found. We have not yet run this, right? So, right. So this is the case. All right. So we run the INTC, the internal stock returns. We generate log returns. We feed the gauge models, and they will give you warnings. And this warnings is totally useless. You can skip that. It's simply a bug. It will not impact your calculations, right? So I1, and you want to look into what's the results of I1, right? Sorry, ML. I think this is ML, right? And let's see what results we have here. So this is the results, all right? So the log likelihood description, you probably don't need to care about this, right? It simply means that the methods when you estimate the coefficients. And if you look at this, the test, all right? So this is the summary ML. So this is the statistics, chi-square, the R-square, 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 arch test, R. So this one, it simply means standardized residual test to testify if there is indeed the impact set. All right. So let me look at the ML. View ML. Oh, sorry. I probably overlooked that. This is actually starting from here, the gauge modeling, right? Gauge fit. This is the gauge fit, and so you can say mean and the variance equations, right? This is the mean, this is the variance, all right? And so this is the coefficients. Mu is 0.0124867. This is a constant, right? Constant, the first model. That means the R equals to the constant plus the shocks, all right? And omega alpha 1, 2, 3, this data is represents for gauge models. The omega represents the constant, and the other three represent the three coefficients of the three variables, the three like the terms. All right. So here is some significance of the coefficients, and unfortunately, we can see that the mu is significant, so that means the average is indeed different from zeros. And omega is constant for the gauge model, the second equation basically, which is very constant. And alpha 1 is constant, but when I talk about alpha 2 and 3, it's not so confident, not significant. All right, so that's probably the gauge 3 model is a little bit questionable. Okay, the other thing, you don't need to care about this. Now we find that gauge 3 is not work because only gauge 1 is significant. Gauge 2 and 3 lacks is not. All right, so in this case, we want to rewrite the models. You just simply redesign the models. Gauge fit, look the second model. The second model, I use the gauge 1 zeros, right? Only one lag include. So summary R2. Look at the summary R2. So the mu is a little bit changed a little bit, but still similar range, right? Omega and arch 1, right? Alpha 1 effects. So you will find that this will be much more coefficients. Sorry, significant for the coefficients, right? Okay, and let's look at the AIC and the BIC. I think in the early chapters in the semester, so we mentioned the AIC and the BIC. AIC and the BIC is kind of like, I mean, this lines. This lines is represents the criteria for the models, right? If you really want to compare the two different models, all right, and the AIC and the BIC is measures how many information is lost during the modelings, all right? Of course, the less information lost, the better, right? So if you look at these models, their AIC and the BIC is a negative 1.33, negative 1.30, right? Something like that. And if you really want to compare with the previous models, negative 1.34, 1.30. It's similar, but I think this one is I mean, it's a little different, right? So, but EBS is kind of a one way to look at that, but not necessarily the best way, because you will see this coefficient is also insignificant here. All right. And now let's plot the residuals. Those residuals represents this. If I use the model 2, because the coefficients are all significant, all right, I want to plot the residuals. I really want to look if the residual is randomness, because if it is not random or autocorrelation, the model is still not good, all right? So I firstly create the time series. The reason is that, look, if you go back to look at the data here, right? This one is the date, 93, so this one is date, this is the calendar. Remember, when we read into the data, we didn't specify it is a time series or not. To claim time series, you need to tell the computer the TS functions. I think we have used that one time, the TS. TS means that, okay, I tell the R that my data is take the time series. You need to plot in that way. If you didn't tell them, for example, like this data, they just simply, the computer just simply say, okay, this is a series of the data, but now happens on the calendar. All right, so this is the only difference here. But it is still fine. We can create a time series starting from 1973, the monthly frequency. There's so many months, so in this case, I can label that each month on the continuous numerical numbers. All right, and then I want to plot several figures. So let's do this. Okay, sorry. There are some arrows. It shows that the figure margin is too large. That means my area here, the figure windows, is too small. So that's the simplest and probably the most straightforward way to do that. You just enlarge your picture windows. All right, so let me try this one. Okay, so you'll find this clearly. All right. Let me switch windows, all right, to this one. So this is original data, the returns, all right, and so this one is a series residuals. So let me see. So can you find, say, the residuals has autocorrelations here? It's actually pretty good, right? You didn't find any significant serial correlations, right? ACF, except for the first one, which is the self. Of course, the self is correlated one, right? So the other is insignificant, right? It's just insignificant, all right? However, if you look at the partial autocorrelation functions, right? If you look at the residual 2, I think it is still insignificant, all right, for the volatility, because remember we have two models. The first one is the mean equation. The second one is the volatility equations. All right, and we find out for the volatility residuals, it is still insignificant. So the model is okay. All right. So let me plot this. When you plot IM2, remember IM2 is a collection of results when I use the gauge fit. And this result generate a lot of figures you can use. For example, the windows show you here. All right, so you have a time series, conditional standard deviations, autocorrelations, residuals, conditional standard deviation, ACF. There's many plot you can use, right? It's very convenient. For example, if I make selection, I want to look at this 3, right? See, you will find out the conditional standard deviations. So it will be show you, all right, the upper and the lower combinational intervals of the volatilities. right? It's very beautiful figures, which is actually the advantage of the R atmosphere, right? Okay, so now I want to quit the session so far. So you just type into the 0 to exit. So I just say 0, right? And I want to exit, right? Exit. Okay, so again, so we finished the Garch models here. We finished the Garch model, and I hope you can implement the similar way like we do, right? If you have a problem, just let me know, right? The second model is about this. Remember when we talk about the Garch models, we assume the randomness of the shocks, the epsilon, the Greek letter epsilon, is a randomness, and this randomness takes the standardized normal distributions. The normal distribution, of course, is very attractive and very easy to implement because we know that the mean average will be highest possibility, with the extreme values lower possibility. It is true. However, sometimes it may or may not because we know that our sample data is a small sample. No matter your data sample it's always small sample compared to the populations. So in this case, if this small sample, you probably need to use the t distribution is better, the students distribution instead of normal distribution. All right, normal distribution only suitable for the population, the original raw data, the large size of data. All right. So let's assume the t distribution. So again, so we still use the Garch models. The only thing here is a conditional distribution used STD. That means student distribution. And let's see the results here. So we use the different models. All right. So we use the Garch 1.1 and the student, we use the students, right? The students distribution models. Sorry, I think it's a bit mixed. So if I use this, so you can see this conditional distribution is we use the students, right? Student distributions, and we feed with the Garch 1.0 models, right? They report me the coefficients mu, omega, the alpha ones. All right. The shape here, you probably don't need to care about. This represents the shape of the rest. Remember, we assumed the t distribution. We want to calculate what the skewness for that, right? How does it relate to the normal distribution? How does it deviate from normal distribution? The shape of the assumed distribution curve, right? And this is the coefficients, and all of them are significant, all right? And you will see their AIC, BIC is also around negative 1.4. It's a little bit lower, right? That means, okay. Okay, let me see what we have here. The next part is not so important, but it's actually very good for to practice coding here. The next part, essentially, I want to plot volatilities, like these figures, like this one. I want to plot volatility, but I also want to plot the confidential interval. In statistics, confidential interval simply means that the upper and the lower levels, like 2 times of the standard distribution. The confidential interval probably like around, I think, let me see this. I think the one standard deviation confidential interval CI is around 95%, right? And the 2 standard distributions will be kind of 65, something like that, right? Confidential interval. So let me run this first. All right, so this is essentially the volatility models we're gonna plot here, right? You want to use the this is the volatility. You observe that because in reality you will never solve all the volatilities, but use the model. I think we use the M4, the second models. We assume the M4 is the Garch 1.1, right? And the Garch 1.1. I'm using the Garch 1.1. We create a time series of the volatilities like this. All right. The volatility, and you can see it's kind of like during the 2001, when there's international crisis, the volatility jumps really high and then decreases. All right, 1975, when there's this volatility high, but usually in other periods, relative lows. All right. Okay, so this is standard deviation, right? And let me okay, so let's look at the next. This figure is trying to plot two confidential intervals, two CI, I think the two confidential intervals, right, around the means. What's going to be the upper and the lower levels, right? This is actually the real data of the Intel stock returns. This is upper and lower level, and where does it come from? It is come from the, if I use the upper and lower level, remember 0.0113 is the mean levels, all right? 2 times confidential intervals, the standard deviations, right? Minus and plus 2 standard deviations, something like that, all right? Okay, so this part, I just go through the codes I upload for the gauge modeling, which is corresponding to our previous class, all right? And your task is trying to rewrite the course materials, particularly on the application. I don't require you to really understand the theories or the duration, but if you can understand, definitely it's fantastic. But most of them are beyond our scope. You just look into the Gauge 1 models. Remember Gauge 1 models, there's some mathematical the properties, and then you go to the examples like the code here, learn how to build the gauge fit models, how to read the output, and analyze the residuals, right, using the ACF, PSCF, right, things like that, right? And then one compare the models, which one is better, all right? Okay, any questions so far? If you don't have so far, let me put out the case studies materials for today's class. Okay, and in the meanwhile, if you have not finished the data downloading, you can continue to do that. All right, it's because in the next we will still need to implement the data file. But now I just want to introduce the text materials, the textbook materials here. Okay, so. Okay, so. So today I'm going to introduce two mini cases, and both of them are relevant to our volatility modelings. And one of them I will give you the full codes, but the other one, I think because due to the lack of the raw data problem, I will not provide you with the code. But it is also not required. Okay, but I will also go over the text materials, but not required for the code implementations. But the first one is required. All right. So the topic of this mini case is to talk about time variant correlation and the beta, right? So the correlation, what I mean by time variant correlation and beta, why this is so important? Let's think about this. There's two stock, right? The other one is the Pfizer and the Johnson Johnson. Both of them are in the similar industries. All right, the pharmaceutical. So I want to look into, okay, so if there's two stock in the same industries, their stock returns moves highly correlated. I want to look into that if they're very similar and correlated. And also, I'll probably want interest in the beta. The beta in finance represents the riskiness of the market. All right. So I just simply want to go back to For example, like here, right, in the traditional capital asset price models, the asset price model is, you can say, for any specific as company stock, the expected return should be equals to risk-free returns plus this one is represents risk premium from the market. The ERM represents the market expected returns. For example, like the S&P 500. This is the minus RF represents excess returns for the market average. And we say that the specific stock should be proportional to the market risk premium. This is the coefficients beta. And the beta will be capture the concepts of that, how the riskiness of the specific securities relevant to the market average. All right, so take a simple mathematics, you will see what's the meaning of that. For example, if I say, if the beta equals 1, what happens? If the beta equals 1, you will see that RF and RF is canceled. All right, so ERI equals ERM. What does it mean? That means if the beta equals 1, the specific individual stock, the returns will be same as the market average. So beta equals 1 simply means that your specific stock, the riskiness is same as the market average. That's it. All right, so if the beta larger than 1, that simply means that this individual stock is riskier than the market average. So the investors demand a higher risk premium. All right, that's also intuitive. So you can see the beta is very important factors. If you really want to know the return for a specific stock, the reason is that RIF risk-free returns usually will be very easy to get. For example, like a 10 years government bond yield. The market average returns is also easy. That's from the S&P 500. The only question that what is the beta? All right, you want to estimate the beta, which is a very important thing. Try to measure what the risk is. All right, so this is the background. Now let's go to the data work here. Okay, our first task is looking into correlation. Okay, so correlation by itself is actually not so straightforward. On the time series, we have two data files. For example, in this case, we have X and a Y. All right, and how do we calculate the correlation? The correlation will be is some from kind of like, for example, the covariance equals to the volatility is minus correlation times each standard deviation, something like that. There's equation, right, for the two assets portfolios. So in this case, we can do this. All right, so for example, the variance of X plus Y can be extended this way, right? The variance of the two zeros together will be each separate plus their two covariance, and X minus Y equals to this. All right, I think this one is some kind of like the mathematical knowledge for very classic. All right, and the difference and the sum together is two series, right? This is the rules here. So how can we calculate? We need to figure out what is the covariance. So covariance will be simply equals to, we simply solve what is the covariance, right? Now you will see that's very easy. You want this one minus this one will be only covariance left, right? Divided by 4. This is the covariance. All right, so and how do we get the correlation? Remember, the correlation simply equals to covariance over each standard deviations, sigma s and sigma y, and we get the correlations here. All right. So we can substitute into the equations. Remember, the correlation equals the covariance divided by sigma x and sigma y. And what is the covariance? Covariance can be expressed in this way. All right. Why we take some steps to derive that? Because we need to derive some formulas. We have a real data we have. All right. You can't find any other ways to do that. You can't. right? Okay, so x plus y, the variance is simply the volatility x plus y. It is very easy. For example, you have the two data, x and y. For example, two companies' stock returns. You simply add them together, x plus y. That's very easy. Two columns add together, and you solve the variance. Of course, the variance, you can't observe that. It is unobservable. You need to use the gauge model to estimate the volatilities for each time spot. All right. So in this case, you can see that we have formulas to let us to implement, directly calculate the correlation so far. Okay, so what do we do here? This one is a kind of summarize all the results. All right. For example, there's several things we need to estimate. We need to estimate the sum of the two series standard deviation, their differences, and each single one's x and y. So there should be a 4 gauge model I need to estimate. But there's just, that looks very similar, right? Just replication of the code. So I think, for example, the authors use a Caterpillar and a Costco stock return. They can estimate the gauge like this. All right, this is, again, this is a mean equation. This is a gauge. I think this is gauge 1, right? There is a shocks and standard and volatilities, right? It's gauge 1. If you take the sum of the two returns, you still can estimate the volatilities for them. All right, so they give you samples. So this is the gauge-based volatilities. All right, this is another one. You don't need to care about the EMWA. This is the kind of a method the author did by themselves, but you don't care about that. All right. Again, so those are things that you don't need to care about. Those are EWWA. If there's second method they want to compare with the gauge methods, so you don't care about them. Okay, so let's directly go to the R demonstration. So we will implement the models based on the ideas of this. Here, we use the covariance to estimate the correlations. All right, and we need 4 gauge models for x plus y, x minus y, and x and y separately. All right. Okay, let me know if you have any questions on understanding our task and the targets here.
You said we need to use covariance to calculate the correlation, and in order for us to do that, we need to, 4 of the models, right?
Yeah, our target is trying to work out what's the two stock series, what's their correlations. And you need to use those inputs.
Right. Okay.
Yeah. And those inputs will be estimated with the gauge model.
Thank you.
Yeah.
Yeah.
Okay, so now before they do that, let's think about some intuition. I think in undergraduate statistics or business economics, all right, I think we can work out the correlation very easily. For example, if I give you 2 data, all right, for example, the say the class 1 and the class 2. For example, there's one courses, 2 sections, right? 2 classes, and each class students have their performance on the grade. I want to look into if there's a correlation between these 2 classes. How do we do that? We need to figure out the volatility standard deviation of the 2 observations. All right, I want to use the covariance and then I work out a correlation. However, remember that if I give you 2 data sets using the traditional statistical methods, you only can obtain 1 correlation and 1 volatility for each of them. All right. it's static, stationary. In the time series, we want to know the volatility and the correlation for each time spot. That sounds really weird because based on our traditional way, if you give me two data sets, I only can work out one value. All right, take the average, work out the standard, work out the deviation, take the square root, something like that. So actually, we have volatility and a correlation for each observation on each day. The reason we can't work out is that we can't observe them or we don't have enough data sets, right? So what Garch model is do this, help us make up this, the problem, solve this problem. Through the modeling, we can estimate what is volatility for each time spot, right? Oh, so that's why if you look at those variables, there's a t, there's always t here, time t, right? It's represented for times each time spot t. All right. Okay, so I would like you to take a few minutes to download data files if you have not done so, as well as open the R files right now. Now I'm gonna use the lab 5 Garch applications. All right, I'll use this one. So let me see. Okay, so before we're going to the details, let's review the data a little bit. So you probably have already downloaded the data with the package, which is the ch5data.zip, which is on my computers here. All right, so this is the ch5's data. So all of the data sets contained in this package also include the other two, which is I separately list out in the list in the Blackboard. They are also included in this package. All right, so you release them, you get 6 ch5 data. So there's several things here. All right, those data files are simply the past year's the stock returns for each companies. All right, so there's the initial A, B, C, D. For example, the Arbor Laboratories. So their initial is A. So it's there's A. All right, for example, Caterpillar, this is C. So this is C. So this is a kind of a list of the firms, a time series returns according to their initial. Right. For example, this is A2A. And you will find this is American Airlines, the Apple, the Arbor Laboratories, as well as others, which is I can't call them, right? Amazon, for example, right? There's stock returns, the TX values. And if you look the ABTSP, this again, so this is also Arbor compared with the S&P 500 returns. This is B2B. This is also the BMY. I think it's the I'm not sure what is that. Bank of the Mellon Bank. I'm not sure. BA. All right. So and BK, BSA, BHT. Those are the initial with B companies. All right. If you take up C2C. Sorry. For example, like this, there is a CVX, CVS, Caterpillar, CPP, Costco, so Comcast, those companies stock returns, all right, as time on the time series, all right. Or if I look, all right, so this is the what we have so far. So I just simply let you know what the data contains in the chapter 5. All right, you can list all the files separately in the same path, or just leave the package there. Because if it were the case, you probably need to change your the path with the course name / ch5 data, because you only work on in this data files. All right. And the first data I'm gonna use the C2C. I will look into the Caterpillar and the Cisco. All right, the Cisco. There's the two examples from textbook. All right, so let me do what we have here. Okay. I will give you a few minutes to review the data file and find out the paths and establish RStudio here. Okay, so let me continue on those things. So we read into the data, C2C, which is the company's initial with the letter C. All right, so let's read into that. Firstly, I need to the Cisco and the Caterpillars, the data, take the log of them. So, all right. All right, so if you look this here, sorry, this is S&P 500 NTC. I think I have not changed that, right? So I think I need to change the site, I think, right? CH5 data here. Now I changed, right? So now there is a different companies, right, with initial say and their stock returns. All right, so this is, I think this is a relatively large data set. How many is it? Yeah, there's a 2,500 and observations. All right, it's still relatively small size, I think. All right, and but now it's because I changed the route, right? I changed the route. I goes to my new package, the stage 5 data. And then I call the FGARCH, wins the GARCH model to estimate that, right? The first one is simply to estimate what is the Cisco, right? The Cisco's volatilities. You simply use that, right? And let's look at the Cisco performance. So if I use the Cisco, this is the mean equation, this is the mean equations, right? Constant. There is a coefficient for the GARCH 1, all right? And the interesting is that the mu is insignificant, but the GARCH coefficient is significant, right? What's the meaning of that? The mu is insignificant. What does it imply? It implies that the first one, the Cisco's companies return on average is no more than zeros. we can't reject the null hypothesis. So that's why you can see the mu here is insignificant. So if you invest in the Cisco's company stock, you probably couldn't get any positive returns in the long run on average. All right. The next one, the Caterpillar. Now, if you look at the Caterpillar, but the volatility is indeed there, right? The volatility model is there. But let's look at the Caterpillars. Okay, so if you look at the Caterpillar, so it seems that the mean equation is positive, it's around 0.5%. So the stock return on average is actually quite low. However, if you look the volatilities, all of them are constants. That's significant, right? The volatility model is useful. All right. So when I use the volatility functions, that means we want to recover. Remember, we model the volatilities, but we need to use the model to recover the volatility and plot that. All right. So there's a function called the volatility that means using the gauge model you predicted that recover that from the volatility plot. All right. So this is the volatility that you get volatilities. All right. And you can have volatilities. All right, for each of them. All right, either one I'll show here because all the results will be stored in this too. And now in the next, we want to use the gauge model, remember, to estimate the sum and the difference between these two. All right, so you first need to construct a new series, the sum and the two separately. All right, and use the gauge fit models. All right, and that's it. All right, warning message. All right, so let me say what's the results coming here. So all of them are constants and significant. All right, this is corresponding to sum and difference. So now so far, now you can see we have all the data available here. We have x plus y, x minus y, x and y separately. So all of the gauge volatilities we have been recovered, right, from the models. And now we can calculate what? The covariance and the correlations, all right, using the equations we basically derived. So, sorry, I think I need to run this. All right, sorry, I think I probably need to run all of them. There's some information I overlooked here. All right, so this is the correlations. And let me see, COR. All right, so you can list them. There's all of the data points here. Data points. So this is represents in the past 2,500 days of the observations, the correlation for each day, right? You can see how powerful the gauge model here, because without the model, just simply for the 2,500 observations, we never can obtain volatility and correlation for each days, right? So because we lose a lot of information, we don't know. All right, so this is the things they directly tell you on each day what's their correlation, the time varying. This is a very important thing, because if you want to establish model valuation, you want to make some investment derivatives, you need to understand what are the time series of those performance statistical moments, right? So the gauge model provides a very good way. So this one, okay, any questions? I hope they can. And in the next, I want to talk a little bit on the time varying the beta. This one is actually very straightforward, because look at the CAPM, right? The beta simply represents the coefficients between your individual stock returns against the market average, all right? And it's a time series, right? So the campaign model simply can be estimated, the beta can be defined and mathematically say the covariance between the individual stock return in the market divided by their variance. So this is the beta, all right? This is the beta definitions. So your task will be simply how to work out the correlation and the variance of the market, right? So this one we use the Garch model, and this one we use the idea we used before, right? How to convert each volatility and convert to the correlation covariance, right? And then we can take this ratio between the two, we can get the beta on the time variance, all right? Okay, so there's an alternative way to do that, but it might be not so, say rigorous. Research, for example. I want to get the time variance, the beta. So another way to do that is that, for example, I want to estimate, say, today. What is today's beta? I can estimate today's beta by average 252 days, trading days, returns altogether before and after the today. For example, for today's beta, I can use the last June, say last June and next June. All right, this gap. I want to work out what is the beta in this period and take the average as today's beta. So you can see this is a very rough estimation. And this way, here I avoid any economic interpretation or approximation. We simply use the mathematical model to derive it. So this should be exactly correct. All right, so this, okay, so this is the kind of results. All right, so for example, after the estimation, the model can be like 1.146. Right, this means this individual stock is riskier than the market average because there's beta larger than once. All right, so let's use the R to show that. All right, so here I just introduced a little bit here because the results is very similar than before. All right. Let's go back to the code, right? In the code, the second part is time variance betas. This beta, we want to use the data of about S&P 500 0110s. All right. So we want to only use the first column. So let's see what it is. We only have one variables. All right, only one variables, S&P 500. All right, and we want to read another tables. Read another table, which is the company Caterpillar. All right, so remember we want to estimate the beta of the Caterpillar, time variance beta. So we need the market average beta, which is S&P 500, and the risk-free rate. All right. So we firstly, using the previous step, we need to work out what's the covariance between the Caterpillar and the market average. That means you need to work out x plus y minus y, x and y separately. You need to estimate the covariance, and then you divide by the variance of the market according to the equation we just introduced for the beta. All right. So here is to construct a new series. All right, sum and minus the Garch model to estimate them. All right, and for each of them, right, the volatility is established. All right, so let me finish those tasks. All right, so the previous step basically construct how to calculate the volatilities for the inputs. All right, let's say the Garch, all of them are coefficients. Or but some stock, if you look at some stock, their mu, their average stock return is still insignificant. That means zeros. It's no more than zeros. All right. This is probably the U.S. stock market is the very commonly seen there. All right. So now after you estimate the covariance between the Caterpillar and the market, as well as the variance of the market itself, then you can take the ratio between the two. You get the betas. All right. you work out the beta, right? All the data has been stored into the beta, these variables. All right, and let's plot that. All right, so let's look at what the beta looks like. All right, so this is the beta. So you will see as time passed by, there's more than 2,000 days, right? So more than 2,000 data points. We can say some days is less than one, some days less than one. All right, so we can't say any company is definitely the riskier than the market average or less riskier than the market average. We just simply say, okay, someday, all right, sometimes maybe change, right? Okay, so this is the beta. The beta is most likely around 1. But here I want to mention a little bit more economic intuition. Why the Caterpillar, the firm risk, is lower or higher than the market average. The Caterpillar is a heavy industries, right? Produces tractors and heavy machines. Those machines belong to the capital goods. It's only for real expansion. For example, the infrastructures. All right, government has the infrastructures plan, and the company want to build in the new plants. The residential apartment want to begin to build. You need to use the Caterpillars, the heavy machines. So those things usually happen during the either could be the economic expansion or when the economics go to the recession. Because when the economy goes to recession, it's particularly at the lowest points, the company began to expect that the economy was going to be recovers. So in this case, I began to buy a lot of heavy machines for the development. The reason is that at that time, those machines will be very cheap. All right. So, and also by using those machines to develop the land, the building factories, it will be prepared for the future demand when they're recovered. All right. So that's why sometimes the Caterpillar will be riskier than the market average because their business is quite moved with the business cycles. We know that business cycle is by itself. It's a big uncertainties. All right. So this is a little story behind that. And let's plot the beta here. All right, so this is the beta. So I think this is exactly the same as textbook. All right. The textbook. So this is the beta. Okay, sometimes the beta could be very high during the 2007. All right, beta is a riskier. All right, and then in the 2008. So it's interesting that you can find that I think we have a 2008 financial crisis. Financial crisis happening around here. Now, what you can find here, you will find that the Caterpillar business already show the crisis emerge actually way before the crisis indeed happens. This is a very useful information. That means if you look at those heavy industries and the capital goods companies, their business performance and our orders will be very good precursor for the next macroeconomics. Now you can start buying that, right? Actually, as early as I think the 2000, not yet 2007, but it's probably at the October of 2006, the Caterpillar riskiness has been goes to very highs. All right, and then drop down. So they're kind of a lead factors. That means they will happen before the real health crisis happens. All right, this is very interesting findings here. We find here. It's beta. Okay, so any questions so far for the time variance, covariance, correlation, the GARS model, as well as the betas here? Let me know on that. Okay, so now in the next, I want to introduce a little bit on the template. I want to introduce a little bit on the Garch, the methodologies on the minimum variance of the portfolios, right? So here we don't have a code because the raw data has some problem, but I just want to go through the ideas behind that. All right. So of course, in the homework, if I really give you such a problem, you still have the data source here, and also I will definitely will be make the data available for you. All right. So, but the idea is very similar, right? So let's look at the minimum variance portfolios, how the guards can estimate that. In the portfolio theories, for example, which is developed by the Markowitz in 1959, right? That he won the Nobel Prize for that findings, right? So because our investors are rational risk rational investors, that means we prefer returns given the same riskiness, and we prefer lower riskiness given the same returns. That means also the mean and the variance trade-off for the portfolios. All right. So sometimes we want to construct portfolios, and we would really want to look into say what the weight ratio of the value in my portfolio for each company is can make my portfolio is lowest volatilities. My target is not realize the best trade-off between risk and return, but instead we really want my portfolio has the minimum the variance of volatilities. This is also very useful. All right, so the mathematical model will be looked like in this way. It will be. I will now test you that. It's just for illustration. I will now test any mathematical knowledge I didn't mention in the class. All right. So, for example, this is a model we were looking to. For example, you have a portfolios, and this portfolio have many assets. All right. So it could be from 1 to K. Right. All of the weight ratios sum up to should be equals to 1. All right, equals 1. And we want to find the minimize the variance. All right. So the variance of the multi-assets portfolio is actually very complex. Now you can imagine that. If you have two assets, all right, what is the variance of this portfolio of 2 assets? What is included? Is this a real is only one numbers or a matrix? That's an interesting question here. For example, you have 2 assets, A and B. I want to know my variance of these 2 assets portfolios. So what kind of value we will have? Firstly, we will have the variance of volatility of A and B separately. The second thing that we will have a covariance of A and B, and the two of them in it, right? So this is actually 2 plus 2 times 2 matrix to express the variance of the 2 assets portfolio. Now think about it, you have a 100 assets or 10 assets, 50, whatever, more than 2. You will find that your the variance will be very complex. All right. So in mathematics, we like explain this way. This is a weight ratio. All of them are matrix, and the times the variance. I don't require you to understand that because if you have a linear algebra knowledge, you probably understand what I'm talking here. But if you don't have, it's still fine because it's not required for this class. You only need to understand is here. We want to minimize the volatility of my portfolios, which is consists of many assets. And my choice decision depends on weight ratio. What is the best weight ratio among my assets can realize the minimum volatilities. All right. So, and you can solve this, all right, with some linear algebra, the matrix knowledge, but it's not required here. All right, because this one thing is that you don't need to do. The other thing is that the R Studio already has function to do that. But you probably it's better to understand what happens behind the scenes of the R Studio. That would be very good, all right, if you interviewed by other people's, all right, and show your adequacy of the knowledge put there. All right. For example, this is a kind of the practice we will have when you implement in estimation here. All right. For example, you have a portfolios, right? This portfolio have Arbor Laboratories, Caterpillar, IBM, Microsoft, and Procter Gamble. All right, there are several big companies, and the weight ratio it depends on time. For example, if you have remember that our data has 2,500 observations, more than that. So you can separate the sample with separate different periods from 1 to 756, 757 to 1512 to the last, right? There's a separate, right, years groups that, right? You can think about this one is a kind of like the first, I would like to say, 6 years, all right, first to 6 years. All right, sorry, the first 2 years. All right, first 2 years. And those are weight ratio because if you sum up together, they should equals to 1, right? Equals to 1. And those weight ratios can realize the minimum variance by changing the weight ratio. This group of number can ensure the variance is minimum. But if you go to the next 2 years or next 3 years, whatever, I forgot what the time units between that, the weight ratio will be changed very largely. All right, if you want to realize the minimum variance portfolios, you need to change the weight ratio. And this went for the last period. And sometimes you need to introduce the short sale. Short sale, that means negative weight ratio. That means you borrow this number of shares, you want to pay back them. This is a short sale, all right, to realize the minimum variance. You can see the minimum variance portfolio, the weight ratio you want to look into is very time variance, all right. And this table is to show you if there's a minimum variance for portfolio for each assets, what's their contribution on the volatilities. All right, and again, so this is also time variance, right? Okay, so okay, so this is they plot the weights, right? They plot the weights. This is time variant changes. Okay, so that's all the mini case I want to introduce tonight. All right, tonight for this year's, and I think we probably have finished all the materials required for the semesters. All right, and so if you have any questions, just later on, just let me know. All right, and in the next few times, sorry, in the next few minutes, I want to demonstrate. I think this semester we don't have time to introduce the some machine learning topics, which is very hot. And in the next, I would like to show you some work that I have done before, or particularly for the fintech courses, which is for finance master program, maybe next year's or next year's, I forgot. And so some projects I have a design, and let me show you how the machine learnings can demonstrate superior performance on the forecasting capabilities here. And let me leave the screen temporarily. Of course, you are encouraged to continue to work on the R Studio. I have demonstrated and implement that. If you have any wrong information or warnings, just let me know if you can't go through there. All right, so let me take off of 1 minute and find out the materials I have here. All right, let me. So this part is just is not required for our class. I just demonstrate how the machine learning methods compare to the traditional time series method that we have learned before. This particularly this masters, and they compare their forecasting capabilities. And I think this is very useful because even for nowadays, I think it's particularly for the pandemic in the recent 2 years, right? Pandemic is kind of like a big shock in the recent years, 2 years. So during the pandemic, of course, pandemic is definitely unexpected. All right, we will demonstrate how the AI technologies and machine learning can demonstrate the superior forecasting, even for such unexpected. So which is the linear traditional time series methods probably lose the power. Okay, so I just simply use the very simple time series data. Here I use the currency rate, which is the Chinese yuan and RMB and the US dollar. The currency rate, the exchange rate. The exchange rate is it's like this. If you look at the time series, all right, and you can see this is the ratio is kind of 6.3 to 6.6, 6.9, 7.2. It represents the how much the Chinese yuan currencies compared to the US dollars. All right, and this is a time series, right? So you can say, I didn't label the year, but I think this is a kind of in the past 20 years, and the most recently. So this period, this is the most recent 2 years. All right, you can see during the recent 2 years due to the pandemic. All right, so the Federal Reserve issue a lot of dollars to the market. All right, so causing the dollars exchange rate, with the Chinese yuan is kind of depreciate a little bit. So that means you will see that the people can convert to $1 with a relatively smaller amount of the Chinese yuan. So that means dollar is depreciate relative to the Chinese yuan currencies. But we know that in the meantime, this is actually not a universe, because dollar may be also stronger with other countries. For example, like Turkish recent 2 days, the Turkish central bank has a problem. The Erdogan replaced the president of the Turkish central bank, because the Turkish lira, the currency is depreciated a lot, as because we're in the pandemic, so the foreign capital will be flat back to the dollar or euros or whatever the countries, right, for the safe assets, for the safe harbors. So that's why for the emerging economies, they're relatively the hurt a little bit. So that's causing there's another different stories. So these methods I developed so far can be applied to any the task actually, right? So for example, this is the Chinese yuan against dollar. This is a truly time series. And if you want to decompose the time series, actually, if you really want to do some analysis work, all right, you first want to look into decompose, right? The trend, seasonal, and the remainders. So that means you want to look into, okay, if look at this currency moves here, right? Can we see if there's any seasonalities? I think there's might be some seasonalities. For example, there's also a little bit bump here, a little bit bump, a little bit bump, a little bit bump. However, it's not so clearly seen, because there's a different magnitude. Even there's a cycle there. And there's any trend, I would say like the trend is kind of like nonlinear U-shaped, for example, like this. All right, so the R Studio gave us such a function that we can decompose the data, and which is a long range trend and the seasonalities. There's not much useful for the prediction, to give you some ideas of what the data looks like. All right, and so in the next, I use several methods to try to predict. All right, particularly I want to use particularly the past history data to predict since 2020 during the pandemic, the currency rate, if the market can predict that. We will see. Okay. I also for another interesting topic, I also do another work. I expect to say in the past 4 years, we know that the Trump government take the positions. All right. So the Trump government take the position. We know the Trump Twitter has mentioned a lot of interesting but very aggressive and interesting, and sometimes some nonsense, or sometimes the reasonable words on the Twitter, but he plus a lot of things on the Twitter on the topic. So we understand there's a verbal language actually embedded a lot of information, particularly, for example, causing the pandemic during the war, causing the pandemic, the Federal Reserve, causing the the uncertainties or whatever, No. So in this case, I using the natural linguistic processing. That means I extract from Trump's Twitter's account. I'm not sure, can we access to the Twitter account? So far, probably we can. It's locked, right? So before that, I can log into the Trump's Twitter in the past 4 years, try to record the number of times he mentioned China or Chinese or whatever Chinese yuan relevant words. And then we plot the frequency, and we will find that near the end of his presidencies, you will find he mentioned China very frequently to the high frequencies. So that's actually mentioned that he is concerned with the issue of the relationship. And I really want to say, if such a verbal challenge, right, or attitudes can be pricing into the foreign exchange market, that means the foreign exchange market, if they buy Trump's words when they make a trading on the Chinese yuan and the dollars. That's probably the very interesting work. I will try to do that. If the Trump's words can be prediction on the Chinese yuan's movement, all right. And you can say before, at the beginning of his presidency, he mentioned also very frequently. But in the meanwhile, when he really busy with the domestic work, he less frequently. But afterwards, at the end, he mentioned a lot. All right. So you can similarly mention a lot of other interesting words. That Russia, for example, also do the similar thing. Other Obama, right? Whatever. So now I use the ARIMA, which we do this for the ARIMA work, for example, to predict the time series. Let's see the results here. All right. So this is the results. All right, this is the results. So this is a past time series. Okay, so I leave the pandemic period blank. So I want to use the ARMA to predict. And I'm not sure if you can see clearly or not. All right, so all right, so you will see that if you use IRMA, the model we use in the class, it will be pretty like this, right? Pretty like this. This is for the confidential interval, all right? That means upper or lower level, there are arrows, right here. So it goes up. I think it's understandable, all right? However, we know what's the reality here. The reality is that during the pandemic, it's kind of like this trend, all right? So this is kind of a, I mean, so the ARMA definitely cannot predict the pandemic. All right, so this is the interesting things here. I also, let me see. So this one, I also use the regression. That means I put the Trump's Twitter's account, the mention the Chinese frequency, and couple with the ARIMA models. I just mean I strengthen the ARIMA models by increasing the regressors, a regressor with the Trump's words frequency mentioned in China. And I've mentioned that you will find that it's increased a little bit, right? The frequency. That means you can see this predicted level is decreasing, which is corresponding to the real ones, right? It's a little bit better than the ARMA if you're increasing the Twitter. We're not saying that the Trump's the Twitter the words could indeed impact the currency market, tradings people, but I think it might be some reasons impact the Trump's attitudes and the Twitter words, and such factors is unobservables, and those factors actually probably the true factors will impact the currency market. All right, but anyway, so kind of like the Word documents does relatively good work for the predictions. All right, now let's go to the next. I want to use the I just select let's look at the two machine learning methods. All right, two machine learning methods. So one is for called SVM, all right, which is this support vector machines and the deep learning, methods. I want to compare this two. So let's introduce the basic idea behind that. So the support vector machines, SVM, it's simply a classification technology. So that means, for example, we have a lot of consumers' data, right? If you log into the McDonald's account, if you go to the Target, you have a lot of footprint, right? If the shopping histories on your account. So of course those data are unstructured data. There's your age, your sex, your buying products every day. You can see the data is very, very messed up. So the SVM, this is machine learning technology, can classify classify your shopping habits, right, on a day-to-day basis. So in this case, those business can get your information on your purchasing habit, right, which categories you belongs to. I use this methodology for the currency market. All right, I use the past data of the currency movement to classify what gonna be the next movement. Is gonna be up or down, right? And how much, right? Based on the past histories. I want to classify the movement directions for the currency. And it was really interesting find that if you look at this is just mathematical models, I neglect that. This is a blue colors, all right? This is the right circles that represents the real data. You can see the Chinese yuan and the US dollar currencies, the moves, right, decrease. And indeed, the this methodologies of the we use the machine learnings is kind of successfully predict the general directions goes down. I'm not sure. I don't know why. I think that based on the past history, they can predict that. It's a kind of mystery to me. But indeed, it shows some things. Maybe the machine learning can capture some very, very tiny and unobservable factors in this periods, right? During this tiny moments here, right? Can make a really sharp predictions on the directions. All right. So remember, if you use ARMA models, they predict the trend will be goes up like this. All right. And now I just continue to use deep learning methodologies, the deep learning. So deep learning also called the neural network. That means we can model the past histories of anything. All right. Not in the time series or like a correlation, forget about that. But we can think about those information as kind of a human mind, human head, right? We have a lot of neutrons in your head. So those neutrons will process information layer by layer, all right? And we use such information, the neutron, like, the neural network, deep learning, to look into the predictions, all right? And we found this interesting. So the red colors represents, if I use deep learning methodology, the prediction on the currency rate, this is a true movement, right? The blue color. And surprisingly, if I find that the deep learning really can predict very exactly compared to the ARMA we learned this semesters. All right, so that's all. So that's I just want to demonstrate to you. I want to just give you some summarization for your future, either career or learning, to mention that. So definitely time series prediction is a very interesting work. Actually, machine learning is, or any other big data techniques, very have a big strength for. And the model we have learned so far, the ARMA, the GARCH models, ARCH, and they are very useful. As I think we also mentioned some other stationarity, something like here, right? So they're very useful, and they're useful for traditional predictions, for example, like oil price, currency maybe, but they're maybe less likely to predict some big shocks, like right? Even for 911, you can use your data. Even for 911, the terrorist shock, right? So the ARMA models can predict the trend very, very good, actually. They only lose the power for the recent pandemic. Okay, so that means it depends on what kind of events they have. So in this case, in the future, no matter what the fancy words like the big data technologies or econometrics, those things will be based upon the ARMA model, time series model we learned so far, and they have some novel thoughts about that. All right, so I just want to demonstrate how the machine learning masters or deep learning can be applied to our time series data to make predictions. So I want to demonstrate some of the work I have done so far for this part, right? For your future learning, if you're interested. Okay, anyway, so I'm gonna close that, and please let me know if you have any questions for any things we can unsolve so far, and any questions on our studio or the volatility GARCH modeling. And if you have no questions, you can leave the classroom. If you have questions, we can continue to discuss. All right. So I will expect I will upload the last assignments at the next Monday morning, and you have probably around 10 days, to submit your solutions. Right. The due is May 5th, I think. All right. So that's all. Thank you very much.
Thank you, Professor, for sharing your work.
Thank you. No problem.
Okay, thank you, Professor.
Thank you. Thank you. Good night.
All night.